Thank you very much, everyone. I think we've called the presentation Moving from Headwinds to Tailwinds. We're becoming increasingly optimistic and hopeful about a growth takeoff in South Africa. And I think I'm not sure of this. Oh, it's working. Perfect. I think South Africa has been stuck in a low growth trap of 1% at best for the last 10 years. In actual fact, since the onset of the Zuma era in 2008. And the reasons for our optimism are both structural factors together with cyclical factors that make us increasingly convinced about scope for growth to potentially reach over 2%, if not close to 3%. And the structural factors that drive this optimism are really driven by two key components. One, Operation Vulindlela, and two, a very strong economic cluster of ministers, which has taken hold since the creation of the Government of National Unity. And I think I can go through them man by man or woman by woman, be that the case. But you've got Minister of Transport, Barbara Creecy, who is, by all accounts, transforming that portfolio. You have Minister of Trade and Industry, Parks Tau, who again, transformational. We've always had a bit of a communist ideological framework framing the trade and industry portfolio, and that's been radically changed with his appointment. Minister of Electricity, game changer. We've seen him before. He was around before, but I think the fact that he's driving the portfolio by himself and not doing it with three other bodies to report to, Minister of Public Enterprises, Minister of Mining and Energy, it was just a mess. At least you've got accountability now. And then obviously the Minister of Finance, who's been around for a long time, safe hands. We all know what we're contending with. And then the last one I want to include in that economic cluster that I think is absolutely critical to bring about a change, in particular in confidence, is the Minister of Police. I think the appointment of Senzo Mkhune is really positive in terms of transforming perceptions about policing and corruption and dealing with it in South Africa. So we're very, very positive about the economic cluster of ministers in driving change. In terms of Operation Vulindlela, for those of you that don't know, Operation Vulindlela is a joint venture between the presidency and the National Treasury to fast-track reforms. Reedy Dix, who's here, is obviously superb. And I think what's very positive, he tells me, is that there's buy-in across every single member of the Government of National Unity into Operation Vulindlela's operations. So there's no fighting about that. There's fighting about the NHI, there's infighting about education, but there's commonality in terms of the Operation Vulindlela's actions. I think the second point to note about Operation Vulindlela that's very important, that we think gives it legs and longevity, is the fact that you've got private sector work streams jointly working with Operation Vulindlela to execute on the structural reforms, which suggests to us that this takes hold, which we're already seeing it's doing, it can actually outlive the Government of National Unity. So that's why we're quite positive about the structural reforms. I'm going to touch on some of the cyclical factors, but I think they're well known. The governor highlighted we're seeing inflation fall to below the midpoint of the inflation target range. We've seen the onset of rate cuts. We're very positive that that continues. So there's a whole lot of cyclical factors. So in actual fact, we should see a virtuous cycle play out in South Africa over the course of the next 2 to 3 years, where you've got a structural reforms working through to enhance growth together with a cyclical impetus. What I want to highlight here is what Valdine highlighted. The bar chart on the top left highlights that South Africa has actually outperformed MSCI emerging markets for the past 3 years, barring last year when we were badly hit by load shedding. And we still haven't seen foreign inflows return. I think investors generally have largely been burnt by Ramaphoria. So I think they're waiting to see proof in the pudding. They actually want to see earnings growth, shoot the lights out, growth above 1% come through. And I think it's a bit I think we're going to get that, and we're very convinced by that. But South Africa's outperformed, and I think Valdine showed you the chart from April or from June post-elections. In actual fact, even if you plot it from the beginning of the year, we've meaningfully outperformed in dollars. What's been quite critical and why we think the markets have been so depressed is that we've been hit by a confidence crisis in South Africa. And I think, again, we go back to the 2008 era when Jacob Zuma came into power in South Africa. But if you look at that chart, it's quite startling, the top two charts. The top left-hand side chart is business confidence, and the chart on the right is consumer confidence. South Africa's business and consumer confidence has not broken even, so not above the break-even baseline since 2008. We've only recently seen it starting to turn and lift, and we think that continues. So there's huge potential. There's low-hanging fruit. If you can just get it right and they can start delivering on structural reforms, we think this is really where you're going to get the huge impetus for growth coming through. We're starting to see results. I think we're through the worst in terms of Eskom. I think it's very clear. We've now had over 200 days with no load shedding. I think quick fixes. I think the team at Eskom said that they've incentivized local power station managers in terms of EAF, energy availability factor, which is the chart on the right-hand side. And it's been amazing what a difference it's made. Apparently, the 6 worst performing power stations last year are now the 6 best performing power stations, just in terms of incentivizing the power station managers. So we actually think, and the reason we're so upbeat about growth, the bottom left-hand or the bottom right-hand side chart for you shows the Reserve Bank's forecast of what growth has cost the SA economy, or what load shedding has cost the economy in terms of growth. And you can see that they estimate that the growth impact last year was to shave off 2%. So just doing matchbox calculation numbers, we should at least be able to get to 2% plus a bit more over the course of the next couple of years just by fixing electricity. Transnet, the bottom chart on the left, is it going to be a bit slower in terms of turnaround, but we're definitely also starting to see a lift off the bottom and some incremental improvements work out. But we think it's probably going to take a bit longer, and it'll probably be a 3-year story rather than a 1 or a 2-year story. So structurally, we think you're through the worst. The headwinds now becoming tailwinds that should lift and support growth. In terms of the cyclical aspects and the cyclical factors, we are constructive on inflation. In actual fact, if we look at our economists' numbers that are being factored in at the moment, they're factoring in a rand at around 19 rand to the dollar. The inflation numbers are incredibly sensitive to the rand-dollar exchange rate. And what I asked her to do is to just give me some scenarios. If the rand's actually at 18.5 or 18, and inflation falls convincingly to around 3% from 4.5%, if that's the case. So we think there's scope for more rate cuts than what's being priced in at the moment, which is around 100 basis points. And in actual fact, if you look at the yield curve chart on the bottom left, South Africa, barring Brazil, has got one of the steepest yield curves with the richest yields on offer. And if we're right, and you have inflation falling to 3% or close to 3%, you've got the political risk premium that's priced into SA bonds closing because of delivery coming through in terms of structural reforms. We actually think there's scope for a very nice rally in bonds. So we are very constructive about the bond market too. But importantly, I started off the presentation by saying South Africa's been stuck in a low growth trap. And I think you just have to look at the chart on the left-hand side at the top. We've been hovering at 1% since 2008. And we think there's scope to go back to over 2.5% easily if we get the structural reforms right. And we actually have the cyclical recovery too. And in actual fact, what that spills over to then, Corp is earnings growth. Corporate SA is always punched well above its weight in terms of the GDP growth environment that they've had to contend with in South Africa. And I think that's been a factor for a very long time in South Africa, because corporate SA was hit by sanctions, which they had to be able to operate in, and they did it very successfully. And I think they've been hit so often that we've got so much operational gearing available that we really upbeat. That corporate SA still delivered 10% plus earnings growth, 5% real over the last couple of years, despite this very low GDP growth environment. So if we write and you get a bit of a growth lift, 2.5% plus, we just think earnings growth could be underestimated and there's significant upside scope. And it's not just driven by resources, it's domestic Inc. companies, industrials and financials. From a currency perspective, we actually think that the rand could be stronger for longer. Obviously, the key call here is the dollar. And the US election is going to be quite critical, but our global strategist believes that dollar strength on a Trump victory will be relatively short-lived, and that as the Fed cuts, the dollar should weaken, and we think that should continue to underpin a stronger for longer rand exchange rate. So what we've seen from a flow perspective has actually been really disappointing. Despite the outperformance, despite some signs of structural reforms working through, the top left-hand side chart shows we have had no foreign interest or foreign inflows since before COVID, in actual fact. The last time we had a bit was during Ramaphoria in 2017, but since then there's been nothing. We have started to see foreign inflows in bonds, which is the bottom left chart. So we're hoping that that starts changing. And as the growth momentum picks up, that we start seeing renewed foreign flows. But foreign investors are largely very underweight in South Africa. Domestic investors too. What I want to flag here is the domestic pension fund positioning in South Africa, if you look at the top left-hand side chart. And it just shows that as a result of the exchange control relaxation that Valdine was talking about, domestic fund managers, offshore weightings is the red line on the top left chart, now overtaken domestic weightings. And we think they're really full up. Most of them are knocking at the 45% limit and are actually starting to repatriate as the rand strengthened and as domestic growth conditions have improved. And I've just finished a domestic roadshow, seeing all the clients, and there's an overwhelming change and shift in confidence again, just within the investor community about growth potential in South Africa. So we're very upbeat about a flow of fund shift over the course of the next year. And then just to highlight some market highlights before I end off, we think South Africa's earnings growth it has beaten EM quite consistently over the last couple of years. And you can clearly see that on the chart on the right-hand side on the top. We think that continues to be the case. So if we look at our consensus forecast, I'm not giving you our team's forecast, but the consensus numbers for earnings growth on the Johannesburg Stock Exchange for the next year or so, excluding resources, if you look at the financials and industrials around mid-teens, 15 to 20%, and financials around 10%. I think it's lowballing it. I think it could be significantly higher if we are correct in terms of our optimism of a growth liftoff because of structural reforms and some cyclical reforms. From a valuation perspective, Valdine also highlighted this, that despite the bit of a re-rating that we've had this year in SA stocks, if you look at the chart on the left at the bottom, we plot the MSCI South Africa versus the emerging market universe, and it's trading still, despite a teeny bit of re-rating, at a 17% discount to emerging markets and significantly lower than where it has done historically. And then if you just look at the JSE Financial and Industrial Index in isolation versus its history, bit of re-rating that we've seen, but nowhere near the 13 times multiple that it's traded at on average over the course of the last 20 years. So we are very constructive, SA equities, domestic Inc. equities in particular. We're very constructive on the bond market. We think there's scope for significant compression in risk spreads, re-rating prospects as a result, working through. And in particular, we think domestic cyclicals, which have started to outperform on the bottom left, will continue to outperform over the course of the next 2 to 3 years on our more constructive growth outlook. And that's it from me.
Okay. So much. We have a couple of questions. We can take one round of questions from here. Anybody? We've got one over here. We've got space for two more.
Hi, good afternoon. My name is Tembega from JP Morgan. Ellie, at the beginning of your presentation, you mentioned you were just talking broadly about the economics cluster, and also you've mentioned that you just finished a roadshow, a client roadshow. Notably, the two latest rulings, from the DTIC, the Comcom, commission specifically, and zoning into Pakstau, who's the new minister. Judging from the latest rulings, the two rulings that have been that were handed against, the applicants. What is your view as to the investor sentiments, as a result thereof? Because one is also conscious that we must be inviting South Africans, for business to be,
Look, I definitely think the competition board in particular needs to be reviewed in SA. I think those decisions were long coming though, and he inherited a lot of that. So I don't think we can judge him on those. From what I've gathered from the two biggest South African client corporate institutional fund managers, they've been very involved in dealing with him and his team about fishing rights and other issues in South Africa that they're trying to help fix for the corporates and get involved with. And they say he has been great. And that he's listening and he's prepared to take all the issues on board. And they've also spoken to him about their concerns about the Competition Commission and the processes that have unfolded recently, which currently he's taken it on board. So let's give him time and let's see how it plays out.
Thanks very much for the presentation. You said that kind of foreign investors are sitting on the sidelines still and kind of they haven't come to the party as yet. What do they need to see in your mind, and how much of that is driven by domestic versus external factors?
I think there are a couple of factors. I think I asked that question to everyone that I've seen recently, and key issues, liquidity on the JSE they'd like to see it improve. And I think we need to see Ramaphosa. They were burnt buying into the optimism in Ramaphosa's early term in 2018. So I think they're a bit hesitant as a result of that. And then I think another very valid point that was made is that a lot of the dedicated emerging market investors are so caught up with China issues and AI issues that South Africa is kind of not as important or critical in terms of the decision-making because of its relatively small weighting within the MSCI. So I think those are the three factors. Obviously, liquidity, it's a catch-22. If we see the growth that we see, a lot of these small and mid-cap names actually could start shooting the lights out and should hopefully start seeing improved liquidity, improved interest. So let's hope that plays out too.
I'm going to be cheeky and ask a follow-up question. Ratings upgrades on the cards anytime soon?
A rating upgrade. I think the one thing that's on the cards is at some point early next year, hopefully the grey listing gets reversed. So I think that will be a very positive development. I think the rating outlook may take a bit longer because the fiscal position, I think you do need to see some stabilization in debt levels. And that may take a bit longer in terms of proving that to the rating agencies.